What if you didn't have to choose between a stock that pays you a ton but is super risky, and a safe stock that's boring? It's an impossible trap. You're always stuck in the middle. Do you chase that insane yield for money today, knowing the company could literally fall apart tomorrow? Or do you play it so safe the dividend is so low, it does absolutely nothing? It's a crazy choice that completely stops you from building wealth. Well, in this video, I am going to destroy all of that noise. I have spent days creating a hand-picked watch list of 5 stocks from the US and Canada that are set up for massive income and insane growth in 2026. This is a blended list, so we're going to cover everything from indestructible anchors to a couple of wild, high-yield plays that I think are going to have a crazy year. Just a quick reminder, this is not financial advice, it's for entertainment. You have to do your own research, it's your money. The numbers we're talking about can change in a second, so check everything before you make a move. Alright, let's go. Stock. Number 1. The energy anchor. Exxon Mobil, XOM. First up is an absolute beast in the energy world, Exxon Mobil, ticker Exxon. For dividend stocks, you want to see a company that cannot be stopped, and Exxon has proven it is unstoppable. Exxon has an insane track record of paying and, more importantly, increasing its dividend. As of late 2025, the company has raised its annual dividend for 43 consecutive years. Just think about that. Through every crisis you can imagine, they never broke the streak. Even when the world shut down in 2020, Exxon protected that dividend before immediately getting back to raising it. That's the kind of discipline that is just unbelievable. Some people now treat big oil companies like Exxon as a high-yield bond that also gives you stock market growth, and it makes perfect sense. For these giants, the dividend is sacred. They would literally rather slow down buybacks or cancel a billion-dollar project before they would ever dream of touching that dividend. As of late 2025, Exxon has a dividend yield of around 3.45%, with a payout ratio that's in a super comfortable 53% to 58% range. This means the dividend is easily covered by their profits. For the last few years, Exxon has consistently delivered dividend growth of 2 to 4%. The big risk is obviously the price of oil and gas. But Exxon's model, where they do everything from drilling to refining, gives it a massive cushion that other companies don't have. If you're building a dividend portfolio for 2026, Exxon is a powerful income-pumping monster to have on your team. Stock number 2, the defensive utility, Amera Inc., EMA.TO. Our second pick is in the super stable world of utilities with the Canadian company Emera, ticker EMA. Utilities are a classic for dividend lovers because they're basically cash printing machines, and Emera is a perfect example. Emera has an awesome track record, hitting its 19th straight year of dividend increases in 2025. That is the kind of consistency that lets you sleep at night. As of late 2025, the stock is offering a huge dividend yield of about 4.46%. Now, you have to know this, the company changed its strategy. They used to grow the dividend like crazy, but now they're aiming for a more normal 1-2% increase each year for a little while. They're doing this to free up cash for a $20 billion investment plan between 2026 and 2030. This insane plan is designed to grow the company's rate base, the assets they earn a guaranteed return on, by a massive 7 to 8% every single year through 2029. It's a genius move. A little less dividend growth now for way more predictable earnings growth later. I love this move. It shows they're playing the long game to build a stronger company, which means even safer dividends for us for years to come. With 80% of its new investments going to Florida, Amera is planting its flag in a massive market. The only risks are rising interest rates and regulatory surprises, but Amera's history and smart plays make it a top-tier defensive pick for 2026. Stock number 3, the financial bedrock, Royal Bank of Canada, ticker RY. Our third stock is a legend of the Canadian economy and a favorite in dividend portfolios everywhere, Royal Bank of Canada, ticker RY. When you talk about dividend stocks that have been around forever, RBC is in its own universe. This bank has been paying dividends for over a century. That means it has survived and paid out through world wars and every economic meltdown imaginable. It's true that regulators have sometimes asked banks to pause raising their dividends during insane times like 2008 and the pandemic, but you shouldn't see that as a bad thing. It's literally a feature of a super stable banking system that puts safety first. The dividend payments themselves never stopped. As of late 2025, the bank is on a 15-year streak of dividend increases. In late 2025, RBC announced another dividend hike, pushing its forward yield to around 4.2%. Its payout ratio is perfect, between 40% and 50%, which means they can easily pay the dividend with tons of cash left to grow, and analysts are predicting massive earnings growth, which should help the bank hit its target of 7% annual dividend growth. The main risks for any bank are the economy, like credit and housing, but RBC is so diversified, with huge wealth management and capital markets divisions, that it has a giant cushion. For a mix of stability, a huge yield, and crazy growth, RBC is an elite dividend stock. Hey, if you're getting some good ideas from this watch list, do me a quick favor and smash that like button. It tells YouTube you're a legend and it really helps out the channel. Thanks a bunch. Stock number 4. The high-yield turnaround. Northwest Healthcare Properties. RY.TO, NWH.UN. Alright, our fourth pick is for those of you who want a bigger challenge. It's a high-yield play with a crazy turnaround story. Northwest Healthcare Properties RY.TO, ticker NWH.UN. Northwest owns a portfolio of healthcare real estate. We're talking medical offices and hospitals. The appeal is obvious. The tenants are incredibly stable. Hospitals don't just leave in a recession, and the RY.TO pays you that income every single month. Now, you have to understand the backstory here. Northwest got into massive trouble with too much debt, and they had to cut their dividend in 2023. But since then, management has been on a mission, executing a huge turnaround plan. They've been selling properties like crazy and using all that cash to pay down debt. Recent results from late 2025 show the plan is working. The company is profitable again and reported a 4.4% increase in income. This has put the new monthly distribution of 0.03 per unit, which works out to a juicy annualized yield of around 6.7% to 6.9%, on much safer ground. Let's be clear, this is not a low-risk bet. The company is still in transition and it's sensitive to interest rates. But if you're willing to take on that calculated risk, Northwest offers a very tempting monthly income stream with the potential for a huge payoff as its finances keep getting better into 2026. Last but definitely not least, we have our fifth stock, Canadian Natural Resources, ticker CNQ. This is one of the best-run energy companies on the planet and an absolute dividend growth machine. While Exxon gives you stability, CNQ is a pure oil and gas producer with an amazing history of being smart with its money. In 2025, the company celebrated its 25th consecutive year of dividend increases, with a mind-blowing compound annual growth rate of 21% over that entire time. That is just incredible in the roller coaster energy sector. So how do they do it? CNQ is obsessed with efficiency and has some of the lowest cost operations in the world. Their break-even oil price to cover the dividend is in the low to mid-40s, which gives them a massive margin of safety. The company has a simple shareholder-friendly plan. Once it hits its debt target, it will return 100% of its free cash flow back to shareholders through dividends and buybacks. As of late 2025, CNQ's dividend yield has jumped between 4.5% and 5.5%. Like any energy producer, its biggest risk is commodity prices. But its phenomenal track record of boosting that dividend through every boom and bust cycle shows a rare commitment to shareholders. For anyone looking for a combo of massive dividend growth and a great starting yield, CNQ is a best-in-class choice for 2026. A quick note on taxes. Just a quick but super important heads up on taxes. Dividends from Canadian companies like Emera, RBC, Northwest and CNQ can be taxed differently. For US investors, you might see a 15% withholding tax. The good news is, you can often claim this back. Even better, in retirement accounts like an IRA or 401k, this tax is usually waived. The rules can be tricky, so this is not tax advice. Please talk to a professional to figure it all out. So, there you have it, a blended watch list of 5 insane dividend stocks to get you ready for 2026. You've got your energy monster in Exxon Mobil, a defensive cash printer with Amera, a blue-chip legend in Royal Bank of Canada, a high-risk, high-reward opportunity with Northwest Healthcare, and a dividend growth superstar in Canadian Natural Resources. This list gives you everything, strong starting yields, explosive dividend growth, and defensive safety. By combining stocks with different strengths, you can build a portfolio that's unstoppable and delivers the income you want now and the growth you need for the future. Which of these stocks are on your watch list for 2026? Are there any I missed that should be on the list? Let me know in the comments right now. I read every single one. And if you want more deep dives like this to help you build long-term wealth, make sure you subscribe and ring that notification bell so you don't miss the next video. Thanks for watching.